Hi, this is Steve Hodgson at Modern Asset Management. I've been in some conversations lately with land investors, and we've been talking about selling on terms. And there were enough of the same questions that I thought I'd do a little Zoom video here so that people can maybe pick up a couple of things. So this is how to create a note worth keeping and that you can sell. And so the disclaimer, nothing, I mean nothing you hear here is tax or legal advice. This is purely educational, even though I am a note buyer. I'm just another investor like you. I happen to have some experience, and by sharing it, I hope that save you some of the mistakes that I've made. So first thing is, why sell with a land contract? Why not just sell for all cash? And if you're going to sell on terms, why not sell with a mortgage or a trust deed, depending on the state? The number one reason I hear for using a land contract over a mortgage is that it's easy to take it back, which sounds a little iffy. If you're planning on repossessing something, then if you do that enough times or a high enough percentage, the regulator will consider that a predatory lending practice. Selling something, collecting some payments, and taking it back right away is a violation of a number of laws in all states. One of the good things about selling on a land contract is you keep the title, and the buyer doesn't get it until he's made his last payment. You have real control over the asset. Downside for me that I've experienced is I'm responsible for taxes when the borrower doesn't pay them, and I'm also responsible for cleanup, nuisance abatement fines when the borrower doesn't take care of the property. I've had both of those things happen independently and on the same property. Excuse me. The big promise that we're trying to accomplish is that we want to buy super cheap. We want to buy 20 cents on the dollar and then sell for full price by using monthly payments to make it affordable. I think this is a marvelous business opportunity, and I fully support it. But like all things, it's got some pluses and minuses again. My favorite deals are ones where the down payment covers the cost of the land. That's just couldn't get any better than that. And then it has a string of monthly income that lasts for several years. We get to keep control of the property. And we've added them to our buyers list. And if they buy once, maybe they buy 3 times. And you also now have a marketable promissory note that you can sell to an investor like me. Where that breaks down is if you're selling loans with small down payments to people that are not credit worthy for small monthly amounts that are difficult to collect. If you sell in that environment, it's going to take you more than a year to get your money back, and that's okay. If you have a 3 or 5, let's say a 5-year note, and you get your cash back in the first year, well, you've got 4 years of income. That's marvelous. That's a good business model. But then you also get in the lower property, the smaller dollar properties with the smaller down payments, you have significantly higher slow pays and defaults. And when you do that, you've created a whole other business to manage. And it's not a business that's very rewarding to be in. But it's the business I'm in. So what makes a good promissory note? The deal's not closed until the last payment's made. Most notes I see have little or no underwriting. It's all the notes that I buy, I'm buying entirely on the spread of the investment to value, that there's either been some payments made and the balance is reduced, or I'm buying a partial of a loan, I'm buying a year or 2, and to keep my investment to value low. And I'm mostly banking on the experience of the land investor in that he knows his market and he has a machine that's set, that she has a machine that's set up and running and allows her to um, um, do more and more deals. So we'll go back to the old school when I started in this business in 1980. Back from the beginning of time, they've talked about the 4 C's of credit. And you don't have to get answers to these through credit reports and FICO scores and all sorts of computerized things. We can get this from the borrower. So the first is the capacity. Do they have the ability? Do they have the ability to repay the loan? Do they have enough free cash flow to make a payment, or are they living right up against the edge, right? Character is now these days defined as a FICO score, and that's not the only way to measure people's performance. But we want to figure out some way to understand if they're paying their obligations, and that can be done through public record searches and frankly talking to them. You have collateral. You have something that, say, you paid $5,000 for, that you're selling for 15, and you're confident that if you have to take it back, it's still worth 5,000, and you'll be able to sell it again, and that's okay. But in having the collateral that they've got $5,000 deposited on means that they're more inclined to make their payments. And capital. What's the total net worth of your borrower? And you're not asking them to disgorge tax returns and all manner of things, but in conversation, you can find out if if the cars are paid for, if they own their house, if they've had multiple credit transactions, large credit transactions before. And so that was from the National Credit Union Association, but it's the same things that were around from the beginning of time that I was taught 40 years ago. So in underwriting is really trying to figure out who your borrower is. So what do you know about them? And while you're finding out things about them, you want to find out if they just want to pay cash. I know land investors who are either completely cash sales, or 90%. I also know some land investors that are 75% on terms. And really what they're doing is they're flipping land to make long-term installment notes. They're really running a finance business with land as the commodity. People have told me that they're concerned that if they ask questions, it's going to kill the sale. And I would rather kill a sale that was going to go bad than shove something through that is just going to be a pain and isn't going to make any money and going to keep me away from doing other things. If your net margin after all your time and effort is 50%, which would be just fantastic, every deal that goes bad, you have to go do 2 others to get back to even, and you've lost the time to do those 2 others because you've been busy dealing with a bad loan. I don't see anybody doing credit checks. I don't see anybody doing bank verification. We manage an active book of, I think we're now 1,300 active loans. We take over 1,000 payments a month, and nearly every one of those was underwritten with a TransUnion credit report, and many had an online bank verification done proving their monthly income. We lend typically between $3,000 and $50,000, and we try to make sure that we're conservative and do a good job. So again, I'm going to say again and again, low down payments equal defaults. Something that isn't a real thing, but is good for conversation, is emotional equity. How attached is your buyer to the property that they're buying? And it's not fashionable to ask this last question, but could 2009 happen again? In 2006, we feels a lot like it does now, where everything was at an all-time high and everything was going up, and I was a genius, as was everybody else. By 2009, I was climbing back out of a deep real estate hole, and took me several years to get back to where I was. Um, so, what kind of contracts should you use? I'm asked about. Um, you need a land purchase and sale agreement and a secured promissory note. Those are the things that you need. And they can be combined in one form. They can be in two separate forms. The promissory note can be 1 page. The PSA is usually a page and a half to 2.5 max. It doesn't have to be like the 100-page realtor documents that you sign when you buy a house. All that is fluff. What's really in there is stating what, when, how much, and what are the ramifications of failure to pay. Don't try to write your own legal documents. There's plenty of other sources that are out there. If you're part of any of the groups that provide coaching, they provide forms that you can edit a little bit to make sure it meets your needs. $500 with a real estate lawyer is worthwhile spending to make sure that you get the right protections in there. That there's hold harmless clauses, there's mutual indemnification, that your penalties meet the laws of the state where you're transacting. But the most important thing is to have a document that you can explain to the borrower, and that you can come to a meeting of the minds, that it has a start date, it has a payment term, that it has an end date, and that she and you both agree. So applications, I have bought some notes in the land space recently that haven't had an original application. It was cut and pasted from emails. It's simple to make a form on your website or in a little link, or even as easy as an Excel that emulates the key points that you'll find on a HUD 1003, which is the application form that you do when you apply for a mortgage. It does not have to be a page and a half. It does not have to list everything, but it should have where you work, where the borrower works, how much they make, how long they've been on the job, how long have they been in their home, do they own or rent, email, a backup email, a secondary phone number, that kind of thing. And in there also is them granting you permission to send texts, emails, and automated calls. Again, I'm going to say at least a 10% down payment. If you've been talking to the borrower rather than grilling them for questions, you're building some rapport, and you can start to find out, well, you make $5,000 a month, maybe you can make $1,000 payment instead of a $500 payment. More is always better. Shorter is always better than longer. But make sure that the terms that you're setting are realistic and that they're affordable, and you're not setting up the borrower to fail. While taking the land back and selling it after collecting a down payment may seem like a good way to make a good margin, the headache of all the work just is I've never seen it pay. Again, make sure your payment is including real estate taxes, and note servicing fee, or some payment processing fee. We require all of our borrowers to agree to an automated ACH when they start their application. It's something that's voluntary. They can cancel at any time. But if they cancel, then they're defaulting on their loan term and their interest rates increased, or there's a higher payment fee for manual processing. That said, we give all of our borrowers access to an online web portal where they can manage their own payments. And if they do that, that's great. Make sure that your loan doc has a default interest rate that matches the default interest in the state where the note is written. Make sure it, or if it's or in the state where the borrower resides, right? So in California, if a Californian buys land in Arizona and is making payments from California, the state of California will say that you're protected under our laws. So you get to be protected under the laws in 2 states. But make sure there's a late fee and an NSF fee that matches the maximums that are allowed in the state. You can negate a contract by having too large of a late fee. Also make sure that the acceleration clause clearly states that the loan will be called due and they have a choice of paying in full or surrendering the property, and that they understand that from the beginning. Even though you will state in the contract that you don't need to notify them, I would suggest that you notify them anyway. A $4 certified mail letter often generates a great big payoff payment. It's not a terrible expense. Now you've done all that, you've sold the property on terms, you've gotten a borrower who's excited to make a payment, they've given you their ACH information, you've got your payment processor lined up, and have you built a system that is going to send automated receipts, or you're doing it manually? If you're starting out new, I would not automate anything. I would do everything by hand to make sure that you touched it and felt it and understood what your borrowers were going to see. I'm guilty of not being good at the accounting and tax reporting side, so we have people that do all of that back end for us. I'm not allowed to touch QuickBooks. That I'm just not. The second is, are you too nice to get serious about collecting a bill? Most people are. The high majority of people are not good bill collectors. It's a conflict telephone call, and we're afraid of it. So don't do it if it makes you feel bad. Get somebody else to do it, or don't sell on terms, or sell the paper, but don't ruin your day trying to build up to make a phone call that that just feels bad in your soul. I've been a bill collector since 1980. I owned collection agencies for years. It's just business for me. So it's easy to start with a few and get a feel for it. But when you get more than a few, like 10, 12, 15, you really need to put some structure together, or you're going to be missing due dates. You're going to have NSFs pop up that you missed. It's just, and the record keeping gets haphazard and reduces the value of the paper. So if you were starting out with a handful and then realized that you didn't like this end of the deal, this end of the sale, and what you did like is getting your cash back faster, you can sell those accounts. There's an active market for buying paper, as we call it. We've been a paper buyer for decades, and I've started working in the land space because it seems like there's a real need for helping small operators get some cash flow so they can become mid-size or big operators. And so we're here to help you do that. But I've bought paper less than 50 cents on the dollar, and I've also paid 95 cents on the dollar or par for mortgages that are performing. So it all matters on how well you put your documents together, how well you vet your buyers so that you're not selling to people who can't afford to pay, and that you're selling property at a price point that we can recoup our money should we have to through a repossession. What should you do next? If you don't have a financial calculator on your phone, go get one. Changed my life. I used to carry one around in my pocket or in my briefcase, and hardly ever took it out. Now that it's on my phone, I use it all the time. It's $6. Go read some purchase and sale agreements on the internet, and you get a sense of what you like and what you think your consumer. Well, if you don't like it, you're not going to be able to sell it to your borrower. So make sure it's documents that that you're comfortable with. Go if you're working in a couple of specific counties, as many of you do. Go to the county website and look at their tax deed sales, their notice of defaults, their foreclosure calendar, and see if there's a lot of that going on. Look at what kinds of properties are failing. There's been a national, now nearly 2-year moratorium on home foreclosure, owner occupied homes, but there's still a lot of other transactions that are going through the normal way. But just make sure you're not walking into deep unsellable swampland, or just some just make sure that you're in a county that's got some vibrancy. Complete some sample contracts yourself, and then see if you've got kids. See if your kids understand them. So if you've got a middle school kid, they ought to be able to understand the terms. Anything beyond them is likely going to be beyond some of your borrowers, and you really should plan for presenting everything to someone who could qualify as a least sophisticated borrower, and that'll keep you from getting any trouble. So it's Steve at modernassetmanagement.com. I'll see some of you on some forums that I belong to. If you've got more questions in specific, I'm happy to talk about them.